Tech stocks badly hurt in the market sell-off here, adding to some big year-to-date losses. Joining us right now to talk about whether he thinks the worst is over or there's more pain to come. Dan Flax, Neuberger, Berman, senior research analyst. That's the question in the morning. What's the answer, sir?
Good morning, Andrew. I think most of the bad news and the headwinds are priced in at current levels. And I say that because the cyclical headwinds are, of course, real. Higher interest rates and inflation are factors. But what we see at current levels are companies that are innovating, investing, really transforming themselves, are going to create value for their customers and ultimately their shareholders. So if you look at a company like NVIDIA, a leader in artificial intelligence, which adds value in key areas like drug discovery, fraud detection, artificial intelligence is very much at the early stages, and NVIDIA is a leader there, and we see significant growth driven by product cycles over the next 12 to 24 months. We continue to like Google. While, of course, the macro impacts them, I think core search is durable. YouTube has attractive growth prospects over the next couple of years, and the Google Cloud Platform is really at the early stages. I'll round it out with Apple, which is certainly being impacted by some of the production challenges in China. They are also not immune from the macro, but we see a continued broadening of the revenue drivers. The iPhone install base is growing. Services is healthy, and you have newer areas like wearables, which are really in the early stages. So Dan, we see select opportunities.
I'm looking at Apple right now, 136, for example. What's fair market value in your mind?
Andrew, I think it's significantly higher from here. I can't give you a specific number, but what I would say is that the free cash flow generation of the company is tremendous. And I think that's going to continue as we look into the latter part of the year ahead, and more importantly in 24 and 25. It's this free cash flow growth driven by the different businesses, iPhone services, iPad, Mac, wearables, that really gives us confidence in the outlook for the shares at current levels, Andrew.
Mm-hmm. Where do you land on like a Meta?
Meta's important to its users and advertisers. We're following the name closely. The company is in transition, and we're seeing traction in areas like Reels. The metaverse, of course, is much, much further out. So we're watching it carefully, but we prefer other names like Google or Amazon, where we see actually a significant advertising opportunity in addition to e-commerce growth.
You just said Amazon and advertising. That's something that oftentimes people don't think enough about, I think, which is to say that the Amazon business increasingly is going to become an advertising business. How big a business do you think that ultimately can be?
Andrew, we're looking at a business that's over $30 billion. Over the next several years, I see that business becoming a $50 to $100 billion business. They're able, and really the story is about empowering sellers, small, medium businesses, and enabling them to deliver value to customers. On the other side, of course, they're continuing to invest in Prime, more one-day delivery, more content. They're doing that even in, of course, what is in the face of tremendous headwinds. But if they're able to balance the costs, invest in new areas, I think advertising, which is one of many examples, they can add a lot of value. And ultimately, that will drive free cash flow growth for Amazon over the next 12 to 24 months.